So today's topic is long-term liabilities and equity. So we are going to deal with this. Under long-term liabilities, we are going to start with lease. Okay. So lease, if I take long-term lease or consider long-term lease should be considered as a liability as well, because whenever the two parties who are involved in lease, one is a lessor and one is a lessee, these two parties make an agreement or contract with each other for usage of property. Lessee wants to use the property, lessor will provide the property to lessee for the usage. Fine. And in this case, there are two types of leases. One is operating lease and one is capital lease or finance lease. These two leases we can differentiate by seeing certain conditions. There will be, US GAAP, they have mentioned 5 conditions, and IFRS has its own way of mentioning the conditions which the agreement should satisfy to, categorize it as a capital lease or operating lease. If some lease is a capital lease, it cannot be operating. If some is operating, it cannot be capital. Fine. So I will not be, using vague terms here. We'll go ahead and see the things in a simple manner. Let's start the basics, learn the basics of leasing and then accounting. So they're asking the first question, explain the financial reporting of leases from the perspective of lessors and lessees. So instead of purchasing an asset, see, yeah, what happens? See, you can buy an asset or you can lease an asset. Lease versus buy decisions in finance we many times see, whereby the financial manager of a company would be, finding out the NPV in both the cases and looking which one is a better option. Basically, what happens if you buy an asset, you have to spend a lot of money for buying a commercial asset. Generally, people take commercial assets on lease for performing their business activities. So, commercial properties are not very cheaper ones. These are very costly ones. And to buy a commercial property, you have to shell out a lot of bucks, lot of money. And then whether the business will work out or will be profitable or not, it's again a big question. Okay, you may do a lot of estimations, you may go for capital budgeting, you may do all sorts of estimations, but those are estimations and approximations, not exact thing. Okay, what is the future we don't know. Same applies with lease as well, but what benefit you have with lease is you're not putting a down payment for buying a asset. Okay, you're just making some payments on monthly basis and you're going for a you're getting a property and you're enjoying the benefits of that property as per substance over form concept. You can show that property as an asset in your books if it's a capital lease, and also then a lease liability is created. Substance over form is nothing but the substance here is more important than the legal form. Legally, you may not be the owner of the asset, but you control the asset and you generate economic benefits out of it. Now, so instead of purchasing an asset, a firm may choose to lease the asset. The lessor will, buy the asset for you and give you on lease. Lessor is only concerned with fixed incomes. He want to enjoy the fixed income by leasing the property. So with a lease, a firm, the lessee essentially purchases the right to use an asset, not the right to own the asset. That's what I am saying. ROU is right to use. Okay, not right to own. Okay, economic benefits the lessee will derive, everything lessee will be enjoying from the property, but lessee is not the owner here. The owner is lessor. From another from the lessor for a specified period which can range from a month to many years. So generally short term, if you consider short span of time for leasing something, then generally it comes under the category of operating lease. For a long term, we generally say it as capital or finance lease. The lessee makes periodic payments to lessor for the use of the asset, like rentals you see. Same thing lessee does. Lessee has to make the payments. Lessor has to receive the payments. Thus, a lease can be considered as an alternative to financing the purchase of an asset. Yes, instead of purchasing the asset, you can lease the asset and you can run your business activity. Just give me a second, just a second. Okay. To be a lease, the contract must meet the following three requirements. Now, what are the three requirements for making a leasing contract? First, there should be some asset which the lessee wants to lease or wants to take on lease from lessor. It must give the lessee effectively all the economic benefits during the term of the lease. Yes, if there is no economic benefit, it cannot be shown as an asset. It must give lessee the right to determine how to use the asset during the term of the lease. That means there should be an asset. Economic benefits from that asset should come to lessee, and lessee should must give the it must give the right. That means all the rights should be given to lessee to determine. Okay, that means he will be disclosing in the contract how he will be using the asset under lease. Now, the advantages of leasing rather than purchasing an asset may include the following: less initial cash outflow, which I already explained you. Typically, lease requires only a small down payment, not a very big down payment. Like there's no, clause like 25% down payment or 30% down payment. No, like that. You can just make a 10% payment, just as an example. And the lessor and lessee will agree what payment should be done, and the lease can be, the lease can be initiated. Less costly financing, because a lease is, you are just making a small fraction of payment to take the property on lease. So of course it looks like it is a less costly financing. And if you purchase a property and business goes into losses, it can cost you a lot. But in leasing, you know I know that lease is not something which is cancelable, but in some certain conditions they can cancel. Okay, because the lease is effectively secured by the leased asset. Okay, yeah. So what happens, the asset still is like, the asset still belong like is owned by the lessor. The lessee just takes the property on lease. Okay, the lessee has right to use of asset but doesn't have the ownership rights. So because the lease is effectively secured by the leased asset, if the lessee defaults, the interest rate implicit in the lease contract may if the may be less than the interest rate would be on loan to purchase the asset. So again, you are learning or understanding why it's less costly financing. Lease is effectively secured by leased asset. Okay, because if you are taking a property on lease, the asset documents and everything is with the lessor itself. Okay, if the lessee defaults, okay, if the lessee defaults, see, in many cases the lessee can default, right? The interest rate implicit, see, whatever the interest rate is applicable, in that lease agreement. See, you are leasing a property, you have an obligation to pay the lease payments also. So over the period of 10 or 20 years, if you have such obligation, it's a liability. And the asset has been purchased by the lessor. They have also made some payments to the bank in form of interest, or they are giving this property on a lease basis. So they also, they would have, used that property for themselves, or opportunity cost also is there in that case. So they want to recover that lost returns from the lessee. Okay. So here the interest rate in a lease contract may be less than the interest rate would be on loan to purchase the asset. So if you are buying an asset, you are paying more interest. If you are leasing an asset, the interest would be less. That's what it is. Yeah, the interest rate implicit in lease contract may be, see, they are not giving a firm answer to this. They are saying it may be generally. It depends upon the agreement between the lessor and lessee. If it's a very hot cake property, then I don't know what's the condition going to be. But in faraway places, maybe less than the interest rate that would be applicable on taking a loan. Less risk of obsolescence. Now, what is this less risk of obsolescence? See, less risk of obsolescence is nothing but the property is used by the lessee. Lessee does not own the property. So if the property for a very long period of time is with lessee, and if it gets obsolete with the passage of time also, lessee has nothing to do with that. The lessor has to take care. because the property still belongs to lessor. So at the end of the lease, the lessee often returns the leased asset to lessor. See, sale and lease back agreements would be there, but that is what we are not discussing here. So they are saying at the end of the lease term, 10 years or 15 years or 20 years, the lessee often returns the leased asset to lessor and therefore does not bear the risk of an unexpected decline in the assets value at the end of lease value. See what happens, sometimes we will expect the property values to go up, but many a times the property values go down and that risk would be there. But here that kind of risk is not there to the lessee. Given the lessor bears the risk of obsolescence, this increases lessor's risk and is reflected in a higher implicit rate. So within the lease. So if the lease is for a very long period of time, the lessor may take a higher interest rate from the lessee because the risk of obsolescence is to be borne by the lessor. So that risk he wants to cover with the higher interest rate implicit in the lease agreement so that he can get compensated for the higher risk what he's taking to take the property on. He's taking to give the property for a long period of time on lease basis to lessee. Okay. So some leases include guaranteed scrap or residual income clauses. Sorry, residual income, leftover income clauses, whereby the lessee guarantees a minimum value for lease assets at the end of lease term. So see what happens at the end of the lease term. Sometimes there is a clause that if lessee wants to buy, lessee can buy, but lessee can give a some guaranteed amount already agreed by lessee. Just a second. So whereby the lessee guarantees a minimum value for leases. So that means at the end of the lease term, the lessee is ready to pay some amount to the lessor And in this case, the risk of obsolescence remains with the lessee. In that case, lessee is going to buy the asset. So whatever it is, lessee is going to bear that. So these are the two standards, IFRS and US GAAP. Any lease in which both the benefits and the risk of ownership are substantially transferred to lessee is called finance lease. Now you came to understand what is finance lease. Here, under both the standards, any lease in which a type of lease, there are two types of lease I mentioned, any lease in which both the benefits and risk of becoming a owner, not the ownership. Okay, so all the benefits of enjoying the property is to be taken up by the lessee, and all the risk of ownership, these are also substantially transferred to the lessee, and this kind of lease may be called as finance lease. If either the benefits of the, so I will write here finance lease. First, benefits. Second, risk of ownership. Both are to be transferred to whom? Both are to be transferred to lessee. This kind of lease is called as finance lease or capital lease. Okay. If either the benefits, if either or risk of ownership are not substantially transferred, so either the benefits or the risk of ownership are not transferred. That means if some kind of lease which is not a finance lease is an operating lease. So what did you understand from this? In finance lease, the lessee is going to use the property for a very long period of time, and that lease is going to be for a long period. Hence, the benefits and risk of ownership will be taken up by the lessee. It's not like they're going to use for long term and it's going to be like that. The lease is of that kind. Okay, the lease here is a finance lease because properly the asset has been financed to the lessee, and it's for a longer period of time. And operating lease is generally for a short span of time. It would be okay. Laptops or some electronic gadgets or some equipments would be used for a short span of time. So that is operating lease, whereby it is not demanding to use for a long period of time. So any given lease will be classified the same way by the lessee and the lessor. Now, financial reporting standards require a lease to be classified as finance lease if it meets any of the following 5 conditions. Now, this is one you should be very much focusing on. So there are 5 criterias. Okay, so as per the financial reporting standards, FRS. So generally we take up this in more often in case of US GAAP. So whenever I take up US GAAP classes, we see all these 5 conditions. Okay, so here already we have seen under IFRS and US GAAP, they are very commonly explaining the things, and the standards say, generally I take up US GAAP and IFRS classes. These conditions I have not seen in the IFRS, but US GAAP I have many times seen. Okay, so so these are the 5 conditions. So financial reporting standards require a lease to be, just give me a second. Okay, so what does the financial reporting standards say, or reporting standards say? So they require a lease to be classified as finance lease if it meets of the any of the 5 conditions. That means either any one condition or any 2 conditions, or five out of five conditions, doesn't matter, but one condition should be satisfied, at least one. Okay, so this is a very important point. Any of the following five conditions, any out of these five following conditions. So first condition, ownership of the leased asset transfers to lessee. The ownership of the leased asset transfers to lessee. So that ownership will be transferred at the end. We have understood this here. You see, given the lesser bears the risk of obsolescence. Okay, some leases include guaranteed residual income clauses whereby lessee guarantees a minimum value of the lease assets at the end of the lease term. Okay, so we have understood that. So that here we will see ownership of the lease asset transfers to the lessee. So if at all there is a lease for 20 years and at the end the ownership has to go to lessee, that will be termed as finance lease. Inbox. Lessee has an option to buy the asset and it is expected to exercise it. So buying option will be there or purchase option will be there. So either this is satisfied, it is a finance lease. Ownership will be transferred. Okay. Or buying option is given to lessee and expectation is that they will exercise. Lease is for most of the assets useful life. I will say more than 75% of the lifetime. So, like lease is for most of the assets life. See, assets life is, 10 years and you have taken the asset for lease basis for 8 years. So that's satisfying the criteria of more than 75% of the assets useful life. The lease has been taken for. Lease has been taken for 80% of the assets useful life. That's what kind of lease? Finance lease. The present value of lease payment, this is PV of future cash flows. Future cash flows here means lease payments is more than or equal to assets fair value. See, present value of lease payments, let's say it is 1 lakh. I calculated, let's say, is more than or equal to the assets fair value that day. See, today is 2024. Date is 9th December. I just entered into a lease agreement and I calculated the present value of future lease payments. And I calculated it and I got 1 lakh as my figure. That is more than equal to the fair value of the asset. The fair value is, let's say, 80,000. So the present value of the lease payments is greater than or equal to the assets fair value. So this is more than this, right? So it is a finance lease. Lessor has no other use of the asset. Asset is of specialized nature, only suitable for used by the lessee. That means he's not subleasing the property to someone else or not using that property for any other usage rather than what he mentioned. Okay, so all these cases you have to see any of the case out of all these five cases satisfied, it's a finance lease. Otherwise it is a operating lease. So some property which is not a finance lease is a operating lease. Okay, please see these five conditions, please. Then I'll move forward fast. Okay. Now we will go ahead with some kind of detailed explanation into the lessee's books, accounting in lessee's books. Okay, so we will see whether a question is given. Yeah, we'll kind of solve that question and understand it in a more detailed manner. Okay. So please understand very properly. IFRS, International Financial Reporting Standard, requires the lessee to record a right of use asset and a lease liability. So right of use asset will be shown in the asset side of balance sheet and lease liability will be shown in the liability side of balance sheet. So, and how will you calculate both of this? Both equal to PV of lease payment. So either right of use asset or lease liability will be present value of future cash flows, and the future cash flows here are lease payments. See, lease payments, right? You should be focusing on this word. On the balance sheet, okay, this treatment is required for all leases except those that are short term up to 12 months. I already told you this is kind of a operating lease most probably. So for short leases, don't give this treatment. For long leases, give this treatment. So that is as per which standard? International Financial Reporting Standards. They say calculate right of use asset or lease liability. And how will you calculate? You will be calculating that as per present value of future cash flows. What are future cash flows? Lease payments. You will be showing both of them in the balance sheet. If any lease is less than 12 months, don't go for this treatment. Or one more clause, if it is less than 5,000 USD, don't go for this treatment. This treatment creates a debt instrument, the lease liability. Okay. So this treatment is required for all leases except those are short term or of low value, full stop. This treatment, the treatment which you are going to give here in these cases is creating a lease liability and is also creating a right of use asset, resulting in a balance sheet that is comparable to lessee issuing debt and using the proceeds to buy an asset. So what is lessee doing here? Lessee is, giving the money to the lessor and using the asset. Okay. Lessee is issuing debt and using the proceeds to buy an asset. That means money is paid to the lessor by the lessee for using this asset. Why will you pay money to someone? If you go to a shop, you will make the payment to the shopkeeper for buying something and using. Okay, same kind of concept applied. So you are paying the money and using the asset. That's what. That means like giving a loan to give, that means giving some money to someone and taking the asset on usage. Right of use asset is intangible rather than PPE, property, plant and equipment. Yes, so amortization should happen. Okay, so what kind of amortization? Straight line or effective interest rate? We will see. Don't worry about it. We will see what treatment. So right of use asset will be amortized over the term of lease with the amortization amount each period recorded on the income statement. So what happens? Let's say your asset is of $100,000. Let's say 10 years is the time period you have taken. 10 is the useful life of the asset. So by 10, so 10,000 is the amortization of right of use asset. This is called capital cost, like depreciation generally. Okay. Plus you have a liability also, right? The interest paid on this liability will be either on basis of interest rate implicit in the lease agreement, or if this is not applicable, incremental borrowing rate. This two you have to check. So incremental borrowing rate, if this is not given, this you have to take. Okay. So you will be making the liability, you have to clear the liability, and till that is not cleared, you will be making the payments, and that will be a combination of principal plus interest, like you do in case of loans. The principal element is going to reduce the liability, interest element is going to increase the liability. Of course, you are adding and making the payments, right? So plus the interest, let's say it is 5,000. Let's say, see, just example, 5% is the rate of interest, maybe just imaginary figure. So this is the finance cost. These two together is lease payment. Okay. Now each lease payment is split between interest and principal repayment. I told you right now, lease payment is split between interest and, I hope this is lease expense to be shown in the income statement. Lease payment is nothing but this one, interest and principal element. The lease liability decreases each period by principal portion of each lease payment, as I told you right now. While the lease asset and liability both begin with the same value and reach zero at the end of the lease. So at the end of the lease period, the ROU has to become zero by amortization, and the lease liability has to become zero because of the constant principal and interest payments in case of lease payments. Okay, principal element will reduce the liability every year. They will have different values during the life of lease, as the following example illustrates. Let's understand. So they say that all the examples in the CFL level 1 curriculum assume that payments are made in arrears. That means you make the payment at the end of each period, not at the beginning. Like in time value of money concept, we did ordinary annuity and annuity due. So ordinary annuity is always the payments are made at the end of the year, and annuity due, the payments are made at the beginning of the year. So rather than at the start, this start thing is not there in a curriculum. So in practice, most leases require payment at the start of each period. We follow the curriculum in our example. So let's say what the curriculum says, we'll follow. Just read this. The affordable company leases a machine for its own use for 4 years with annual payments of $10,000. At the end of the lease, which is also the end of the machine's useful life, affordable will return the machine to the lessor. So here they are going, the purchase option is not there. They will return it back. The interest rate implicit is 5%, assuming that rate of use as a right of use is amortized on a straight line basis. Very key thing. Over the, so what is the asset here? I haven't given, right? Over the term of lease, calculate the impact of lease on affordable financial statements for each of the 4 years. Okay. So what we are going to do first, we are going to find out the lease asset and lease liability. So sorry, asset information will not be given. Really sorry, because I really explained you right now that asset value is nothing but present value of future lease payments. So we will take the future payments as 10,000 for 4 years. So N will be 4. Take your calculators, I by Y, 5% rate of the interest rate implicit is given. PMT is 10,000. Yes, lease payments are to be received. Future value is 0. Compute PV, you will get the present value of the future payments, that is 35,460. This is your lease liability and also right of use of asset. The right, then we will find out the straight line amortization. They said, right, the asset will be amortized for a span of 4 years and straight line amortization. So by divide by 4, this will be your right of use asset over the 4 years time. Okay, so this is straight line amortization. Now so the asset is of 35,460, liabilities of 35,460. This is the capital cost, as I said you. That is, and then we will be finding out, we'll be seeing the liability and the interest cost as well. So here we have looked, right. So will be amortized over the short term of lease with amortization amount each period recorded on the income statement. Now, beginning liability first year, your liability is 35,460. It's going to get reduced every year. So lease payment fixed is 10,000, which is a combination of principal and interest. Interest is 5%, which is calculated on this liability. Just do the calculation part. Outstanding amount for the first year is 35,460 into 5%. 1773. Reduce this 1773 from the lease payment, which is 10,000 fixed. This will be the principal element. This principal element you have to subtract from this for calculating the next year's liability. So 35.
8227.
Yeah, you can add this interest to this and subtract this. You'll get the same point. This subtract this. See, 35,004. But I will not complicate here. 1773 minus 10,000. So this will be adding to this and this will be subtracted. Automatically it will lead to this only. So directly I'll take this and subtract from this. So you'll get 27,233. Again 5% on that is going to give this. This minus this. Again this is your principal. Again subtracted from this will give you this. Again on this 5% subtracted from this. Again this is your principal repayment. This minus this. Again 5%. And you have to subtract this from this, you'll get the principal element. Okay, ending lease liability is going to be this every year. Okay, it will become zero at the end after the principal repayment is made. Okay, at the end of the lease term, and you have done the depreciation amortization thing, right? You have to subtract this from this every year, it will become zero. So just make this note, please. We will see the discussion part. Okay, just do this. Following. Yeah, do this.
Yes.
Yeah, please, please. Done. Hello. Done with this? Now,
Yes.
the interest expense. Here you see the interest expense 1773 for the first year will be recognized each year in the income statement. So this you put in the SOPL or income statement as interest expense. Uh, on the separately from the amortization expense for right of use asset. See, you will show this as interest expense, and also amortization of asset you will be showing as a separate expense 8865. On the balance sheet, the right of use asset value decreases by this each year, and the lease liability is reduced by principal repayment from column 4. Note that the book value of the right of use asset is less than the book value of the lease liability. See, book value of this is less than this, because this is more, right, and this is less. Note that so this is because principal repayment in early years of the lease is less than the straight line amortization. Here this is fixed. Here this is where is that, like 8665 is fixed. But here what happens, as the time passes by, the interest element reduces and the principal element increases, and then what happens, your asset value will become lesser, okay, and your liability will be more, okay, because the liability value, the interest element is going on decreasing, the principal element is going on increasing. The more principal element will reduce the liabilities in the coming years, okay. So note that the book value of the right of use asset is less than the book value of the lease liability. Right of use asset is here less than this. Yeah. During the life of the lease, this is because principal repayment in early years of the lease is less than the straight line amortization. In the later years, the principal repayment is greater than the straight line. So at the end of the lease, both the lease liability and asset will become zero. Okay, one day they have to become zero. Once the cash flow state on the cash flow statement, repayment of principal will be classified as cash outflow from financing activity. Under IFRS, the interest portion may be either operating or financing. Under US GAAP, they are very firm about this. They will show in operating. Okay. Okay, so we will do one thing. We have done the introduction part right today. We will stop it here. Tomorrow we will take the same topic from under US GAAP. We will see the calculation here, and we will compare the operating and finance lease, and also the ratios. Tomorrow leasing will be done for you. That will be the last class for leasing tomorrow. Okay, and then non-current liabilities will start. Okay, so let's connect tomorrow. Thank you so much.